Moving on, the National Social Security Fund has announced a 9.65% interest rate for the financial year 2021-2022 on members' savings, a rate lower than the 12.5% members under last year. The Managing Director, Richard Biarugaba, says that the low return comes on the back of the global runaway inflation, the turbulence in regional markets, and a huge payout in the midterm access that saw a drop of about 540 billion shillings in growth. Let's take a look.
I have the pleasure to declare an interest to be paid to the members for financial year 2021-2022.
That was the countdown as the General Duties Minister delivered the much anticipated news. A low interest to workers as the Provident Fund announces 9.6% from highs of 12.5%. News received with mixed feelings given the current inflationary pressures, but workers' representatives seemed happy with this share of the cake.
We were expecting actual lower interest because of the problem, because we also squeezed you. I remember we really squeezed you to get our mid-term access, but you have performed. I also want to thank our Director of Labour for the support you have given to the workers.
Fund managers defended this low payout and insist it's a reflection of economic shocks on the global and regional markets where the NSSF has sizable investments.
We would have earned an extra 0.96%. If the market had not crashed, I know the word crashed is a bit of an exaggeration, if the market had not lost its value in Kenya and we had not lost any money on the stock exchange in fair value valuations, that would have been another 1.5%. So if you put those two, 0.69% and 1.75%, today we would have declared 12.09%, and that would have been comparable to what we declared last year. So for the analysts, midterm cost us almost 0.69%. The market cost us 1.75%, and therefore we ended up declaring 9.65%.
Hundreds of billions were paid out in midterm access recently, and the Managing Director explains the implication on interest payment to members who withdrew their money.
You will get interest on the portion that you did not withdraw. Right. So if you had 100 million shillings and you withdrew 20 million shillings, because that was 20%, you will get interest on the 80%.
On the 80%.
Yes,
that
but you won't get on the 20%.
Fund officials say last year they paid out 80% of the total collections as benefits, adding for the first time growth of assets is being driven by income rather than contributions.
Such a brilliant conversation. Now joining me in studios is Richard Biarugaba, the Managing Director of the National Social Security Fund, arguably the hottest seat in the Ugandan financial sector. Good to have you, Richard.
Thank you so much, Andrew, for having me on the show.
Well, it's very exciting, but we want to understand, what does the 9.65 mean to a saver? If you could break it down for us.
Well, first of all, if you look at our performance as a fund, definitely last year was a huge challenge. Two major events that were out of our control. The first one being the fact that a new law came in place. We had to pay out quite a sizable number of our members. In preparation, we had no idea how many people would turn up on our door steps, so we had to have a lot of liquidity. That meant that we couldn't invest in long-term instruments. We had to invest in short-term investments in order to cover that liquidity. So the risk and the reward of short-term against long-term means we had to lose a bit of return. The second area that was beyond our control is the markets. In the middle of the financial year, first of all, it started off with the shocks on supplies in places like China, where you know, the ports were not bringing in the goods as they were required, and yet we had come out of COVID. The whole world wanted to consume. There was a probability, in fact, there was a reality of inflation, and central banks had to do something. And when interest rates are hovering around, sorry, when inflation is hovering around, interest rates are increased in response, and that means that in Europe, those assets become more valuable because they are now receiving a return from their governments on bonds, which are high value, and therefore they take their money from Africa, which is risky, and take it back to Europe. So we saw the stock market crash, and of course it wasn't helped by the fact that Ukraine came under attack, and that impacted on the rest of the supply chains. So it's been a very unfortunate situation, which has led us as a country, has led us as a fund to be able to reduce the amount of return. So that return is really 12%, 12.5%.
Yeah.
Subtract our cost of doing business, subtract our tax, and remove the opportunity cost that we would have got if we had invested in the long term, and also remove the losses on our share positions, especially in the Kenyan market, which means that we had to reduce the amount of interest we pay to our members. But as I tell people, markets recover. In fact, they did recover 1 month later. So if we had done these financial statements 1 month later, perhaps would have been talking a different interest rate.
And that brings me to another question. With all these turbulences going on in the financial world, how did you manage to sail through and you still give us something above the inflation?
Yes, it's something we call the strategic asset allocation. So if you were paying attention during my presentation today in the Serena, you will have seen that we have maintained a 78% allocation into fixed income. We've maintained a 15% allocation into equities, and we've maintained a 7% allocation to real estate or alternative assets. So why do we put a long, position on our fixed income? It's because it is an asset that you are sure about. It's called fixed income because it gives a fixed return. You invest while knowing what you're going to get as a return. It is less risky because these are governments that we've lent money to, Uganda, Kenya, Tanzania, Rwanda, and therefore you know that these governments will not default, and therefore you are sure that you will get your money in the future and you'll get a good return. Of course, equities are up and down, but generally they go up. And that's why we have a smaller allocation.
That makes sense. Richard, we could have this conversation till when the cows come back, but what does the future look like for a saver like me?
I think the future looks bright. I said that. The good news is that the law has been changed to be able to provide our saver more products. So we will be able to provide products in the short term, we'll be able to provide products in the medium term, and we will be able to improve on the products that we provide in the long term. So that is one of the good things. The second thing is there is technology. Technology is helping us to bring the unit cost of production down. The unit cost of the efficiencies are going to improve. Our customers are going to become more engaged. We are producing more self-service products, and we believe that at the end of the day, we are going to be able to grow, especially in the informal market. If you look at the informal market, opportunities are aglow. If you are looking at my presentation, the mandatory market has picked, and we believe that the new growth area is in the area of the informal market, and we know that the informal market need products. They are our new customers, and we're coming for you.
Wow. There you have it. That brings us to the end of this conversation with Richard, and I hate things about the app. It makes it easier for me. Let's take a break for now, and we'll return shortly. NTV Tonight, it's still underway.